even hear you come in. How are you doing? Welcome to episode 9
of Mo Money,
the investing show for millennials by a millennial. I am M.C.Mo, Moolah and Cheddar Mo. We're working to get you rich later now. Now, last week we discussed sources for finding the best investment information and the best ways to stay informed about the market. Now, let's get to this week's
stock market update.
Now, the market finished slightly down, ending a 5-week streak of gains as we go into the holiday weekend. Crude prices also slipped this week below $40 a barrel at one point, as well as the U.S. oil rig count dropping 15 rigs to 372, the lowest since 2010. And in the continuing amazing drama of Valeant Pharmaceuticals, the CEO this week, Mike Pearson, stepped down after pressure from the board. And just when you thought that it couldn't get any better, the U.S. Senate filed an inquiry with Bill Ackman of Pershing Square and Valeant to speak on the gouging of drug prices, which they promised to give full cooperation. And with all that craziness, the stock still managed to rally over 7%, and I'm sure this saga will only continue to get juicier. Now, this week's topic, we will discuss stock price movement, the causes of what makes indices and stocks move on a daily basis. But first, let's start with a little stock market history. Let me take you back to 1882, New York City. Friends and colleagues Charles Dow and Edward Jones venture out to start their own company, DowJones and Company, financial news source dedicated to reporting news on Wall Street without bias, which at the time was an incredibly revolutionary idea, considering companies would have no problem bribing reporters to write a favorable review about their company to help their stock price move. In 1883, they started a 2-page paper every afternoon, which included the first ever stock market index, the Dow Jones Stock Average. Their paper eventually became what is known today as the Wall Street Journal. Dow Jones Industrial Average, S&P 500, and the Nasdaq are the 3 most popular indices used to measure how the economy and, more importantly, the stock market are doing as a whole. The indices are made up of anywhere from 30 stocks on the Dow Jones Industrial Average to hundreds on the S&P and the Nasdaq. Each stock is assigned a weighted average, meaning when it goes up or goes down, it proportionally affects the overall value of each indice. Now, let's get down to what moves the price of a stock. Now, there's a multitude of reasons that a stock can move up or down on a given day, but at the core of it all, one basic economic principle: supply versus demand. More sellers, the price goes down. More buyers, the stock goes up. Remember, it's easy to hear about the stock market and think of it as this larger-than-life, unhuman being, but at the end of the day, the market is a living, breathing organism of people, just like you, with the same fears, hopes, intelligence, and irrational behaviors. Remember, the stock market is just a place where people come to speculate. Nobody knows exactly what a company or a stock is going to do. One irrational investor or institution can cause the stock to go ripping higher or sinking lower, but only a large buyer can really shake up the price. Here's why. Like I said, the core reason the stock price moves is supply versus demand. Think of it as a marketplace for food. A guy wants to buy 10 apples. Shares of apples are going for $1 each. So a person is willing to sell 10 apples for $1 each. They meet in the marketplace, they exchange their shares or their goods. Now let's say someone wants to buy 100 apples. Someone may be willing to sell 10 apples at $1, but nobody else. Now, to get the other 90 apples, the buyer will have to look to other suppliers in the market to meet his demand. He may find someone willing to sell 20 apples for $1.25. The new price for a share of apple is $1.25. Another is willing to sell at $1.50. Another is willing to sell at $1.75, etc. Since the demand for apples has increased and the supply has shrunk, the price of the apples or the shares has risen. Vice versa. A guy who's looking to sell apples for $1 each. People know apples aren't worth that much, so he will have to lower his price till he is able to find a buyer. This is why prices of stock change throughout the day. Shares of a company always trade. Big companies can see millions of their shares traded each day. More heavily traded stock means less volatility in price. Now, on average a day, without any news on the company or any dramatic news in the world, a stock may move up or down, usually no more than 1%, or even just trade flat. Now, that's the basic reason for a stock move. Now, like I said, people are the sole cause behind a stock moving. Their ideas and speculation manipulations that cause them to make moves in the market and decide whether to buy or to sell. And let's be honest, humans are often irrational. But let me break it down and try to help you understand what exactly causes these emotions within investors that cause what may seem like these irrational moves in stock prices. First thing, earnings reports. A publicly traded company is required to report their earnings quarterly every year. That's for a year. Most of them all do it in with the same 2 to 3 weeks. It's called earnings season. And it's like Christmas season. It can be a time of mass hysteria, buying and selling. On TV, you'll see a company reporting its earnings per shares and its revenue. Now, if they beat the estimation, you can see the stock jump as much as 15 to 20% higher. Like that. If they don't beat expectation, that thing could go sinking really fast in the other direction. Like that. But here are some of the irrationalities of the earnings reports. Sometimes, a company could miss on earnings by a measly few hundreds of thousands of dollars. It doesn't matter. People are selling that stock. Another is they could beat, but the company lowers guidance or their expectations for the upcoming year or the upcoming quarter. This can cause investors to worry and sell the stock, even though they had a great quarter. Because remember, in the stock market, it's fuck what you did. What will you do next? Earnings season is like March Madness. I love it. Second is macro news. World news can greatly affect the price of the stock, whether it be new president in some country over in Europe, some new law passed in China, or a war in the Middle East. Stocks that could benefit or be hurt by this sudden new change of news could see its stock price dramatically change, even if the fundamentals of the company haven't changed at all. ISIS attack in America. America decides to step up their bombing in Syria. A company like Lockheed Martin goes soaring higher. It may seem irrational, but remember, it's people speculating. One unique cause has recently been the presidential race. Better believe that Wall Street watches very closely, trying to figure out who will win and what that'll mean for the market as a whole, even though little has been said about the actual stock market. Now, third, micro news. In other words, news that comes from the company or affects the company personally. This could be the new CEO or the death of a CEO, also a new product or a new service, like the announcement of the new Star Wars was great for Disney's stock. Other news like misstated earnings, an investigation, or fraud by the company usually causes the stock to drop. Fourth, I told you about diversification, about all the different sectors that make up the stock market. Energy, healthcare, consumer discretionary, technology. Now there is a thing called sector rotation. This is when mutual funds, ETFs, big financial institutions will sell off one entire sector and move towards what they believe is a more lucrative sector of the market. When this happens, you can see cream of the crops drop like they were other shit stocks. Take for instance energy. Now the price of oil has been dropping for over a year, and the best fundamentally sound companies have been getting beat up as badly as the poor fundamental heavy debt shit oil companies. This is caused by sector rotation. Nobody wanting to own these energy stocks because of the falling price of oil. Another example, months ago Hillary Clinton tweeted she would aggressively go after price gouging stock in a tweet. That day the healthcare sector got rocked 5%, and it's been volatile ever since. When oil went down, the market realized, holy shit, I have so much money left over after I fill up my tank of gas. I totally have money to buy shit that I don't really need now. And you saw a rush of investors into the consumer discretionary name. This is how sector rotation can cause the stock price to change. I know it seems unfair that the best can trade in lockstep with the worst, but that's how it goes sometimes. But it usually doesn't take long for the market to realize when a good stock has been drastically and unfairly beaten up and undervalued. Now the fifth and final reason for stock movement, this one may shock you and it may not. A lot of the trading that causes the price and the market as a whole to change is computers, or more precisely algorithms. A lot of big firms create and use these ultra super complex algorithms that decide when to buy or sell a stock. Their hope is to remove all emotions from trading, which investors know trading with emotions can be very dangerous. They write into the algorithms that tell these computers buy the stock at this price, sell the stock when this happens. Some are even created with social media scanning capabilities, which allow the computer to make a decision based on what's being talked about on social media sites. These firms and the creators of the algorithm are made up of people of like mind. Okay, so when one person is selling, you can almost guarantee the League of Extraordinary Ivy League Minds will also be selling. This is one of the dangers of computer trading. A lot of people don't like it and think it hurts the market, but for now, that's just the way it is. I know these 5 reasons can be a little overwhelming. You may find yourself thinking, oh great, I have to be afraid of computers, ISIS, Hillary Clinton, and some irrational big institution when it comes to my portfolio. I can't handle the pressure! I assure you that you don't have to stay up at night, losing sleep, worrying about all these things. These things can cause stock to move irrationally at times. Markets tend to be very rational, or at least come to their senses after an irrational move. But like I said, it's always good to stay in tune with the market news and the world news as well as the company's news, just so you can always be ready and understanding of a move in the indices or the price of a stock. I like the to take this time to give my condolences to everyone who lost someone, knew someone who suffered a loss, or was injured in the recent attacks in Brussels. I'd also like to take this time and urge everyone not to let your fears take over your rationality. Muslims are not responsible for this violence. ISIS and ISIS alone is responsible. It is our responsibility to show Muslims from all countries that we stand with them, not push them away and make them feel alienated and cause resentment. Finally, I'd like to shout out to all my Jewish faith people, happy Purim, Mazel Tov, or whatever, and to all my Jesus lovers, happy Easter, and to all the atheists and agnostics, well, happy weekend. Hope everyone has a good one. That's all for this week's episode of Mo Money. Thank you everybody for watching. Hopefully this helped explain to you the boring moves to the wild move in the stock price. So go ahead, like, comment, share with everyone. Subscribe. Hey, follow me on Twitter, like me on Facebook. Mo Money, signing out.